Stop staring at the $130 million net loss. It's an accounting ghost story designed to scare off amateurs. While the market panics over forensic analysis reveals that this loss is essentially a strategic red herring. Beneath the noise, Deepexi has successfully performed a brain transplant, moving from legacy data janitor work to becoming the central operating system for enterprise AI. It's like finding a winning lottery ticket in a pile of trash. Most people just see the trash. We see the payout. Deepexi is running at a 71% revenue sprint, but keep an eye on their shoelaces. AI now powers over 61% of their top line, and margins are thickening like a good roux. However, there's a friction point. Their customers are accepting the software faster than they're opening their wallets. This is the classic working capital trap. They're winning the tech race, but they're doing it while carrying a heavy backpack of unpaid invoices. The legacy business, FastAGI, is basically a horse carriage in a rocket age, growing at a measly 5%. But look at the rocket booster. FastAGI exploded by 181%. They aren't just managing data anymore. They're selling the logic that makes data useful. In 12 months, they went from 20 AI clients to 70. That's not a trend. That's an invasion. In the world of enterprise software, if your margins aren't growing, you're just a consulting firm in a trench coat. Deepexi's consolidated margins hit 55%, up 3.2 percentage points. The secret sauce? They started using their own AI digital employees to build software for their customers. They've replaced expensive human hours with scalable silicon logic. It's the closest thing to a money printer the sector has seen this year. Here is the fatal attraction of high-growth tech. Revenue grew 71%, but accounts receivable surged 85%. In plain English, for every dollar of growth, they're waiting longer to see the cash. It's like selling a Ferrari, but accepting a promise to pay written on a napkin. If this gap doesn't close, the growth isn't a victory. It's a liquidity crisis waiting to happen. Most tech firms hide their losses by capitalizing R&D, essentially turning expenses into imaginary assets. Deepexi doesn't play those games. They expense 100% of their R&D immediately. Their current loss is artificially high because they are paying today for the profits of 2028. It's an aggressively honest accounting policy that tells us management isn't trying to cook the books. They're trying to build a fortress. Post-IPO, the balance sheet looks like it just went through a detox. That $500 million equity deficit? Gone. It was a technical glitch related to preferred shares. Now, with a debt-to-asset ratio of just 23%, they have a cleaner balance sheet than most of their peers. They aren't just solvent, they're war chest ready. Deepexi OS isn't just a platform. It's the central nervous system for a factory. It moves beyond chatbots to action bots. It can read a blueprint, check a warehouse in real time, and execute a Python script to fix a supply chain snag. It's like upgrading from a library card to a robot librarian who actually reads the books for you. They've codified 286 specific industrial skills into their AI, from tax planning to BOM analysis. This is the ultimate customer lock-in. Once a company builds its daily workflow around these 286 digital agents, leaving Deepexi becomes operationally impossible. It's not just software. It's a digital ecosystem your business can't survive without. Deepexi is solving the labor bottleneck by cloning their best engineers into AI agents. This isn't science fiction, it's productivity. Their revenue per capita stands at $124,000. By using AI to automate pre-sales and coding, they can grow their top line without hiring a single extra human. It's the dream of every McKinsey consultant. Infinite scale, zero headcount growth. Let's talk about the hard ceiling. You can have the best AI code in the world, but if you don't have the chips, you have a paperweight. Sanctions on high-end GPUs are the sword of Damocles, hanging over every Chinese AI firm. Deepexi is mitigating this by fine-tuning open-source models, but make no mistake, silicon is the new oil, and the supply lines are fragile. Always bet on the jockey. The CEO is an ex-Alibaba cloud veteran, and the CIO comes from Hillhouse Capital. This isn't a group of garage startups. It's a big tech SWAT team. They understand both the architecture of the cloud and the ruthlessness of the capital markets. It's like having the Avengers run your IT department. They're sitting on $83 million from the IPO, and they aren't wasting it on fancy offices. 40% is going straight back into the R&D furnace. They are buying the fastest drill to find the deepest oil in the AI market. With 15% allocated for overseas expansion, they're clearly signaling that their AI skills can speak more than just Mandarin. In the AI gold rush, compliance is the new gold. By securing ISO certifications and passing rigorous deep synthesis filings, Deepexi is building a moat of trust. For a massive state-owned enterprise or a bank, trust is more important than speed. They are positioning themselves as the safe pair of hands in a very chaotic market. The verdict? Deepexi is a sector outperform, but it's a bumpy ride. We're looking at a high-performance sports car that has a slightly leaky gas tank. The tech is world-class, but the cash collection needs fixing. If they tighten the cash cycle, they're a unicorn. If not, they're just another high-burn tech story. Keep your eyes on the receivables, not the headlines. This isn't just data, it's institutional intelligence. If you want the full forensic breakdown of $1,384, HK, or our other tech coverage, email our team at sales@hdinresearch.com. Don't forget to visit hdinresearch.com for the full PDF. Hit that subscribe button, follow us at HDIN230, and tell us in the comments, is Deepexi's loss a red herring or a red flag? Let's talk numbers.